Hey, good morning, everyone. My name is Chris Lopez, and I'm a realtor over here at Your Castle Real Estate. And this is our February Roundup webinar for investing around the Denver real estate market. So, this is a monthly webinar we do. And my goal of this webinar is to make it a virtual, let's get together, have a cup of coffee, talk about deals that happened the past month, talk about interesting news, statistics, stories, just those anecdotes that you hear just around the shop or having a beer or having a cup of coffee. So that's the goal. It's very casual. Any questions you have, please type them into the Q&A box anytime during the webinar. Charles and I love those questions. And I know making live webinars is difficult, and I know watching recorded webinars can be difficult as well. And I realize most people can't make all the webinars. So in addition to doing this live, we also post the recording to our YouTube channel, and I also take the audio and then post it to our podcast channel. I'm a big fan of podcasts, so if you can't make it live, listen to podcasts while you're driving around to work or between appointments and catch up as to what's going on in the market for the past month. And just search for Denver Real Estate Investing Podcast, and we will pop up at the top of Google and the podcast channel. So I've got my co-host today, Charles Roberts. So he is an active investor, active realtor, and also the president of Your Castle Real Estate and Sherwood Real Estate. So Charles, welcome.
Thanks, Chris.
And before we jump into the details for the February month, I got an exciting new monthly event that's actually starting on March 13th. So Greg Parham over at First Alliance Title years ago used to have a monthly meeting of real estate investors and real estate professionals, and he's bringing that group back to life. So it's called the Investor Advantage, and it's going to be a monthly like lunch and learn every single month, where the format's very simple. You show up, have lunch. During lunch, one or two presenters will present on a topic over lunch. Afterwards, you can ask the presenter questions. There will be a small panel of other people there, and it should be a great networking opportunity as well. So the two main goals are education and networking. And it's meant to be good education and not some front to sell you, a $20,000 boot camp or some nonsense like that. So it's $25, and that covers lunch. And the first one is March 13th at the Dave & Buster's. I forget the address, but if you go to the Your Castle trading calendar or the trading calendar on Denver Investment Real Estate, you'll see it on there. Any questions, email me, email Charles. And Charles, I think you're actually the presenter at this first one, right?
Yes, I am.
Great. So you guys have heard Charles speak and present before. Get more knowledge from him. RSVP for this. There are still some seats available. So jumping into the details for this month, every month since we started this, we've had at least one deal to talk about, and that's a deal that we closed upon in the previous month. And the month of February is the first month that we have no investment deals closed, so no specific deal analysis to talk about. But I want to start this webinar off with a question to Charles, because while we were prepping for this, we got into some interesting dialogue, because I was saying, wow, just the market is so tight. Anyone that spent a few minutes understanding the Denver market knows the inventory levels and how out of balance it is. And asking Charles, I go, how long can this go for? How does this affect investing? And he said, well, let me ask you a question here, because he said, I've been doing real estate for a while, and I've been on the other side of the coin where you're buying property while the market's going down versus going up. And it's similar emotions, similar fears, some different, but hey, you're either buying in a down market or an up market. And ask yourself this, Chris, would you rather be buying in an up market or a down market? And I thought it was a really interesting question. So Charles, I'll let you kind of start filling in some of the details that you were telling me about what it was like 10 years ago and how the market has shifted.
Sure, happy to. Did you see the question from Peter, which is sort of relevant to this? Do you want to jump on this first or afterwards? Either way is good with me.
Let's jump into it afterwards, since we've already topped on this subject.
Okay, great. So yeah, we literally, Chris and I were just chatting 10 minutes before this, having this conversation. And I was telling him, it's something that I talk to people about because people who are newer at this, especially who don't have the important perspective, the historical perspective, they can't see something that I think people like who have done it for a while can see. And it literally is, do you want to buy in an up market or a down market? Anyone who says, I just want to buy when the market's normal, that's an unfortunate statement. And let me show you why. Because there
Oh,
is no such
let me
thing as a
switch to
normal
your screen,
market.
Charles. Hold on.
Okay, great. We're going to switch the screen and I'm going to open this up right here. And this is something you've probably seen before. 1 second, just switching screens here. Let me know when you see it, Chris.
I see it. You're good.
Okay, so this is just our 1971 to 2017 numbers. These are Denver metro homes. You go back to 71, the average price was about 30,000, 37,000. Now it's 477. It's important to understand markets go up for 15 years, they go down even for a couple of years, they go up for 15, 16 years, they crash for 2 years, they go up for 7 or 8 years, and we'll see what happens. So if you're thinking about investing, and Peter, I think this is going to be somewhat relevant to the question you're asking, you don't generally have a market that is actually, finger quotes, normal. It's just that isn't real estate. They go up, they go down, they crash, they do stuff for 15 years. That's the nature of the market. So a question you might want to ask yourself, Peter and everybody else on this, is would you rather buy in an up market and a down market? And I've done in both, and I've seen people do it in both. And I got to tell you, all things equal, I think I'd rather buy in an up market. Because what you also see is people who buy like right here thinking it's going to be a great time, or maybe right here because the market's going down for a few years. That can be very tough. You're generally not going to buy in the perfect market. You don't know what the future holds, but that's one of the things to ask yourself is in an imperfect world where the future is uncertain, what we do believe, at least what I believe, is the market's going to continue to go up for a while simply because of the demand and supply. I'll talk about that in a minute more. But I think I'd rather buy in an up market than a down market. But you may have a different opinion, and that's okay. But ask yourself that question.
And so I've been thinking about this since the 20 minutes ago we first talked about this, Charles. And my rational side, my logical, rational brain says, oh, it'd be great to buy in a down market because I can buy in the dips and get properties at a discount for a bit, like the dip, 10, 12 years ago, and then be able to ride the next wave up. And again, I was not in the real estate when the market was tanking, but I started thinking about what I was doing when I was actively trading the stock market, and I was trading it around the time, before, during, and after when the whole stock market crashed, Lehman Brothers went out of business, and I was actively shorting stocks. So I was actually actively betting that stocks would go down, and I'd make my money if the stock price dropped. And the interesting thing, even though it's a very similar dynamic, whether you're betting the price goes up, betting the price goes down, it's still, it's basically a 50-50 bet. And it's very similar. But I remember my emotions, it was so much harder for me to not buy the stock going down, but it's so much harder for me to stick with my plan. I said, okay, here's my exit point, whether it's my profit target or my bump stop. So if it goes against me, I'm gonna cut my losses at this price and just walk away, 10% down. And the psychological thing, which was a good lesson for me, was it was so much harder emotionally for me riding the market down than it was riding the market up. Now, I don't know why, but I'm sure there's, psychological reasons for that. And I started thinking, okay, well, in real estate, damn it, I'll probably do the same way where am I going to be laying awake at 2 a.m. at night worrying about, hey, did I buy or how much farther can it go down? So you got my brain thinking, and it's very, very interesting. So I don't know if you have any insight or comparisons to that, but that's just my thought process. I'm thinking out loud.
All I can tell you is that there's never a perfect time to buy. We're never certain about the future. And also, a lot of people just shouldn't buy real estate because it is risky. You might buy here and it might go down for a few years. You might buy here and it goes up for a year, then it goes down 25%. That's why I'm a long-term thinker. I only buy real estate for the long term. And frankly, I only work with investors who buy real estate for the very long term. I don't want to work with anybody who's taking any risks. So you as an agent, maybe listening to this, working with investors, or as an investor, that's a really, really important thing to think about. Market is skyrocketed. We'll see where it goes. I'll talk actually in the next segment about why I actually do believe that market is going to continue to rise. I just bought another little property a month ago. I wouldn't have bought it if I thought the market was going to tank. But at the end of the day, we don't know. And at the end of the day, I don't care because I buy properties and I hold them forever, which actually leads very nicely to Peter's question. If I can bring it up, Chris.
Yeah, I want you to read it so everyone knows what Peter's asking.
Yep. So Peter says, I'm considering selling rental condos in the Denver area to free up money to buy in other markets out of state that are a lot less expensive. Is this a bad idea? Well, absolutely not. But if you said, is this a good idea? I would say, well, I don't know. The truth is, it's not black or white. It depends on a massive number of things, one of which is you're predicting the market, which I believe that you can't any better than I can or anybody else can. Like, we're not sure. I think you're asking the right question, and I think that you should think through some of the options. And by the way, feel free to just give me a call or touch base. I'd be happy to walk through this more in detail. But I'm going to start by saying it is neither a good idea nor a bad idea. And I will promise you, anybody who says different either doesn't know what they're talking about or they're selling you something. Either way, you need to get into the gray area. For example, let's say you have a lot of equity in your properties here in Denver, and you can buy in another market where maybe you know something about the market. Maybe you're from that market. Maybe your brother lives there and he can manage the property. Maybe you can move that equity to another market, buy additional properties, and build long-term wealth. That could make a great deal of sense. Maybe you have equity, but you're looking at a market that someone told you might go up 15% next year, but you have no basis in that market. You don't know anything about it. You're trusting a turnkey company. I would say, well, maybe question it. So to me, I think it's less about market timing, which I'll say over and over again is a very difficult thing to do, and more about what makes sense for you. What do you have going for yourself? So feel free to touch base and we can talk more about it. And I'm going to pretty much give you lots of questions, lots of things to think about. I will tell you that when I bought another round of property starting a couple of years ago, I already owned property in Denver. I had them paid off. I was facing the exact same question 2-3 years ago. And I scratched my head and say, I'm going to go with what I know. I'm good at Denver. I understand Denver. I've been through a downturn. Kind of can't get any worse than the last downturn. And I suffered through that, but I know what I know. And I felt that I was going to stay in Denver, which is what I did. And I ended up buying 7 additional properties, and I've been very happy that I've done it here. I will say the last thing on this topic I would say is no matter what you do, if you do it for the long term and you're business-like about it and you're not too speculative, you probably will do well. Chris, jump in with any thoughts as well.
Yeah, I don't know how many details we can go on over the webinar, Peter, but if you got some basic numbers to share, or maybe even better, like if there's a particular market you're looking at, type it in there. There's a chance that someone else on the webinar may know about that market, or someone that listens to the recording may be able to reach out to you and you guys can talk some numbers and get some insight. But I'd be curious to know, kind of the basic numbers and what market you're looking into. So if you want to share that, please type it in there and we will come back to it in a couple minutes.
Let me throw one other thing out at you. That what I saw during the last upturn and downturn in this period here was there were a lot of folks, both locally and around the country, who would put together data reports and say you should buy in Georgia, or you should buy in Savannah, or you should buy in Oklahoma or something. And they would have tremendous data. And a lot of people chased this data, and a lot of people got destroyed by this during the downturn. And I saw it firsthand. And it just helped me realize how speculative it is to chase locations around the country based upon what looks like sure data, which I can tell you the last time people did this was not sure data. I would just be careful about that. And when we talk about our data here in Denver, we're constantly saying we're really good at the past. Here's what we think might be happening in the future. But don't come to Denver because it's going to spike in the next year or two. Who knows? Just be really cautious about it. So he's throwing out Oklahoma City, Kansas City, maybe Omaha, areas of the country that might be really, really good places to invest for the long term. What we have seen, I actually know a little bit about Omaha, is that that's an area of the country that hasn't seen much appreciation for a long period of time. Maybe it will go up. Maybe you have a reason you want to buy there. I just can't say what will happen. I would say that, like I said, I'm happy to discuss with you some pros and some cons about moving your money, but the number one thing is if you have a lot of equity tied up in your property today or properties today here in Denver, that's a wonderful problem to have. And if you're a person who wants to buy more properties, wants to take on more risk, believes that the market will go up in the next 10, 20, 30 years, no matter where, it makes a lot of sense to potentially unlock that equity. Maybe they're 1031 exchanges, maybe they're HELOCs, or maybe you sell the property. So, touch base, happy to chat about it. Really good question, lots to think about.
So, Charles, you were showing me a slide as we were prepping for this. I don't know if it was one of your slides or from a Denver Post article, but it was titled "The Housing Gap," and that was
Yep.
really interesting.
You see it on the screen now?
Yep, I can. And just so people who can't see it or listen to the recording, I'll post links to these slides so you guys can check them out afterwards. So do your best to describe it verbally too, Charles.
So the Denver Post about a month ago came out with a really, really great article, and I'd like to commend them anytime when they come out with stuff that I disagree with. Then I'll disagree. When I come out with stuff that I agree with, I want to highlight it and say, "Great job, guys!" And this was a great job, guys, report. So you'll see on your screen, those of you who are watching this, you'll see the housing gap. And what they said was the Denver area has been adding households, and that means people. A household, the average household is about 2.49, just about 2.5 people per household. The Denver area has been adding households at a higher rate than housing units for a decade. This is critical. So everybody knows the market's really hot. Everybody understands the basics of supply and demand. There's more buyers than sellers. But this actually gave some terrific insight, just some basic data that really shows what happened. So let's go back to 2001, 2002, 2004. What you see here is the light colored bar are the number of households being added in Denver. So for example, in 2004, you had about 12,000 households being added, and there were 20,000 housing units. What does that mean? A potential oversupply for a period of time. But starting in 2008, what you see is year after year after year, more households being added to the Denver market. So example, 2008, we added 20,000 households, but only 10,000 units. Well, no problem. We're a big city. We could absorb that. And then the next year, we added 19,000 households and only 10,000. So you start to see, geez, we're adding lots more households. And then the crash happens. And what happens? Nobody builds anything, but people still moved here. So in 2011, we added 21,575 households and added fewer than 5,000 housing units. 2012, 13, 14, 15, 16. See what I'm saying here? Going back to 2008, every single year, we have added thousands and thousands of more households than units. Guess what? This is a housing crisis. This is exactly what you would expect when you're adding more people looking for property, and people who own property are terrified to sell because they don't know where to move. And what I'm trying to give you here is the perspective, the brilliance of this diagram right here is you've got this 9 years of tens of thousands of more households being added in housing units. When do you think this is going to correct? Do you think it's going to correct next year? I don't. So I'm the first one to say nobody can predict the future, but let's just pretend we can. This is going to take a while. I mean, I'm just going to guarantee it, at least for my portfolio. I'm not selling anything. I just bought another one. Like, this makes me quite certain that for the foreseeable future, we do not have enough households for the number of people who are moving to the Denver area. Just yesterday, I toured Mercy Housing just to learn more about it. We actually gave a $20,000 donation to Mercy Housing, and they said, "Wow, who are you people? Come and let us show you what we do." And what they talk about is the flip side. We as investors go, "Oh no, when's the next crash going to happen?" What they say is there are people who do not have housing. Why? Because of this article, because exactly what we see here. This is a housing crisis that Denver is going through right now. It just so happens that investors, you come out well in this housing crisis. I don't think it's going to change anytime soon. And this is a really, really good explanation of why. That's my belief.
Can you hear
If
me,
you have any
Charles?
questions, yeah. If you have any
Okay.
questions on that, I just wanted to kind of give my little screed. Feel free to jump in, Chris or anybody else. But this is about as good a visual as I can explain to myself and people around me on why I think that we're in a relatively long-term period where we're going to continue to have a housing gap that's going to push prices up. I do believe it. I know the market will go down someday. I don't know if it'll crash, but I believe this needs to correct. We need to have fewer people here and more houses for the market to begin to correct.
So I know projections are very, very, almost worthless, but they're fun to talk about. Have you seen from any of the meetings you go to or resources you have any projections as to when the housing supply will start matching back up with the households? Are there any realistic projections on that you've seen, or ones driven by good data, or are they just all over the board?
Well, I mean, the data is how many permits are being pulled per year. And in 2017, I think it was right about here. It was like 23,000. So, like, okay, we added some more units, and of course, if a permit is pulled for construction, that's probably 12 to 18 months out. But we have these literally tens and tens of thousands of over demand for this undersupply. So the best we can say is, well, the builders will build when they can, but there's not enough land. They complain about loans. They complain about finding drywallers. There's no reason to think that this line, this housing unit added, is going to go to like 30 or 40,000 anytime soon. Nobody believes that. So all we can do is shrug and say, sounds like it's going to be a bunch of years before we get back to a balanced supply-demand situation. So Mike's
So,
got a good
Mike,
question here. Yeah, let me read this off. Seeing all the apartment buildings being built makes me think more units and households in 2018. I don't think so. Not from what I've seen. You can see it did shrink a little bit. This came here and this came here. So I can't guarantee you. I can show you the 2017 permit numbers, but and that will translate at some point into 18, 19, and 20, the number of units. But I would also point out that many of those apartment buildings are cranes downtown. And I actually just heard this recently. Around the country, 80% of multi-units are considered luxury that are being built. And Denver's in the very same situation where nobody's building lower to middle class apartments, virtually none, and one step short of virtually none middle class. What you see is a lot of higher end product, both in Denver and around the country. But let's just say you're right, Mike, you might be right. Let's just say that in 2018, we build, say, 22,000 units, say right here, and then we only have 20,000 new households added. Well, we still have all of this oversupply that is stretching the market. That's exactly my point. It doesn't mean that in 1 year, if we have more housing units built than housing demand, it actually solves the problem. Why? Because we have 10 years to catch up on. That's the point of what I'm trying to say. And I do believe maybe at some point it'll happen. Like, I don't honestly know or care. Like, I'm just sort of looking objectively. But my objective is that there's this whole amount of demand that needs to be soaked up by supply. 1 year of supply over demand is not going to cut it. It's going to have to be years and years, like 10 years, just like this, to get back to some sort of balance. That's the way I'm looking at it.
So if you guys have questions or thoughts, anything, keep typing them into the Q&A box. We will be monitoring those. And Charles, let me ask you this, because I've had some people ask me this over the last couple months, just, looking, similar insight and thought to you, just, hey, the market looks like it's just going to keep going up for a while. No major indicators that's going to turn around, but hey, you never know. What are some safeguards, though, that people can do to, hedge against a potential downturn or the market plateauing? Is it more money down? Is it buying a certain cash flow? Get any recommendations or guidelines on what people can do to, hey, play it safe and play it smart?
So, of course, the first answer is don't buy real estate. Like, if you want to be really, really safe, then don't buy real estate. You won't probably make a lot of money either, but it's up to you what risk you want to take. So let's say you want to buy real estate but dip your toes in. Well, then maybe you put 30 or 40% down. Maybe you get a 30-year fixed instead of a 7/1 ARM. Maybe you buy a property that you would consider less speculative, or a property that doesn't need a lot of work if you don't know, how to do that work or work with contractors. There's this whole spectrum that I learned the hard way when I started 20 years ago, because I was the biggest dumbass. When I started, I thought I was smart. I thought I could do everything, and maybe you see now why I'm a pretty conservative everything, because I made so many mistakes and got myself into a lot of trouble because I didn't think that way. And that's why everybody should at least think about the question you're asking, Chris, about what they can do to potentially reduce their risk. However, the problem could be that you reduce your risk so much that you spend the next 10 years looking at Excel spreadsheets and never buy anything. Whatever's right for you is what I would say to my agents and my clients. You've got to figure it out. I'm always happy to have this discussion, but I won't have an answer. I'll just have lots of questions, and to try to feel out meaning the person I'm speaking to, risk level and risk tolerance. And then whatever's right for you is right for you. The number one thing, though, I would say is think long term. Buy a property, hold it for 20 years. I will guarantee you'll be happy in 20 years. You're probably going to be happier much sooner as well, but I'll guarantee you in 20 years, you're going to be happy and rich.
That's great advice. Thank you. So we got a few more questions in here. Charles, Doug asked, do you have any thoughts on how the increasing interest rates might affect the market?
Yeah. Hey, Doug. So this is, I laugh when I get questions like this, only because basically it's a good question. And the answer generally is, well, they haven't really been increasing. They have the last couple of weeks. But if you've done this for a long time, I would get the exact same question 10 years ago. So if you look at every article on interest rates in the last 10 years, every article has said interest rates are going up. Well, they haven't gone up yet, but they're about to go up. And they've been wrong for 10 years. So it's hard to take these seriously, because the bottom line is, Doug, nobody knows. Nobody knows when interest rates are going to go up. But let me tell you the truth. Real estate agents have an enormous incentive to tell you interest rates are going to go up. Why? So you'll buy property sooner and they'll make money sooner. Do you hear what I'm saying? I am being very insulting to my own industry. NAR, who leads the industry, they write article after article. Lawrence Jung, who's the lead economist at NAR, writes article after article about how interest rates are going up. Why? Because it's speculative, but they're saying, well, you should just buy now. So I'm very, very adamant about making sure people understand nobody knows when interest rates are going to go up or down. They happen to have gone up the last couple of weeks. Now, to answer your question, we've done a lot of research on this, because we get this question. We want to know. And what I can tell you is that we looked back 40 years and we looked for a correlation around Denver, I believe it was, on interest rate, meaning 6%, 8%, 12%, whatever, and the number of units sold. And what we found was not predictable. What we found is over about 10% interest rate, we absolutely saw fewer properties being bought, i.e. the 1980s. When interest rates went 10, 12, 18%, no question about it. You see a correlation and a dip in the number of sales. But under 10%, we saw no correlation. So anybody who tells you that when interest rates go up, something is going to happen, they don't know. They're just making it up. Or they're citing a ridiculous article written by someone who doesn't know. That's my pretty harsh opinion. So what I would say, Doug, and everybody else is, A, forget about interest rates, because you don't know what they're going to do. And B, even if you knew what they were going to do, it's very, very difficult to know how it's going to affect the market. Our best analysis, and I'm happy to share this slide with you, Doug, just email me, was that above 10%, there seems to be a correlation. Below 10%, we couldn't find one over 40 years.
Hey, Charles, I'm going to steal your screen for a second. Yep. Because I thought this was an interesting email newsletter from a recent survey. Can you see my screen?
Yeah, is that Lonnie's? Yeah.
Yeah, so Lonnie Glessner, you know him better. He's a loan officer here in Denver. He's got does a great newsletter. But one of his topics here was, will people quit buying homes if interest rates hit 5%? So Redfin did a survey at the end of the year of 4,000 prospective home buyers, and they asked, if mortgage rates were to rise above 5%, what effect would it have on your buying plans? 27% said they would slow down their search in hopes that rates would come back down again. 25% said no impact. 21% said it would increase their urgency to buy sooner. 21% said they would have to look in more affordable areas or buy a smaller home, and only 6% would cancel their home buying plans. So, interesting.
And I've known Lonnie for over 10 years. He is one of the most thoughtful loan officers in the business. I actually just taught at his monthly group, taught 30 people last week. He's a really good loan officer, writes a great newsletter, and I really, really like exactly this. All I can say is that real investors do not think about interest rates and how it's going to affect the market. Tough statement. I stand behind that statement.
So a follow-up question from Doug, and then George will come back to you in a second. So Doug says, everyone has a different investment plan, but at what rate does it make sense to acquire property to a dollar cost averaging approach? One a year, as fast as possible, one every 5 years?
Yeah, so just so people know, so Doug, like we worked with Doug, we helped him buy his first, I believe his first rental property last summer, and I think he made a great decision on the property. So we've talked about this dollar cost averaging, and I'm a dollar cost averaging kind of guy. Why? Because I think chasing things like interest rates or speculation on what the market will do is just like doing it in the stock market. It's kind of silly to do that. So in terms of dollar cost averaging, to answer your question, well, it depends how much money you have. Like if you've got $10 million to place, you might not want to buy a property every 5 years. In your situation, and I know you're doing some stuff with Pine and stuff, for example, the answer is whatever makes sense for you. The whole dollar cost averaging thing would be if you believe that you can't market time, but you believe that over the long term, real estate may be a good investment vehicle, then you would plan with you and your family to say maybe buy one once a year or once every year and a half, depending upon your income. To the extent you want to be more aggressive, you'd buy a little more often. To the extent you, obviously the opposite, then you would buy a little less often. But dollar cost averaging is an acknowledgement that you can't time the market, but still want to get in without trying to time the market, and then not freezing yourself out because you try to time the market and there's never a good time to buy. And when you've done this as long as people like I have done this, what you see are real, oftentimes very smart people who never bought anything because it wasn't the perfect time for them. And, that's too bad, but they didn't make a lot of money they could have.
I agree with you 100%. I mean, that's the only logical conclusion I can come to is just I consider myself a smart man, but not smart enough to know what the heck the market's going to do, other than, yeah, it'll probably be more than in 30 years than it is now. I mean, that's the only thing I can conclude. So George asked, do you have the date and the name of the Denver Post article with that housing gap graph? Do you have that off the top of your head, Charles?
No, I don't. It was like a month ago. Just send me an email and I'll send you the URL to it.
And I will, Charles, CC me on that because I'll post it along with the recording so everyone else can access it too.
Sure, happy to.
So Peter asked, what percent of rookie agents, like realtors, do not normally renew their license, and what percentage of agents typically do not do a single transaction?
So the data that I got from Jeremy Lambert at Your Castle and from Pat Armbrust is that last year 87% of new agents did not renew their license after 1 year. It's an unbelievable statistic. The vast majority of first-year agents don't make it to their second year. Some combination of they thought it would be easy, they didn't realize what it takes to be an agent, they ran out of money because some terrible person told them it would be easy. 87% is the number I have that don't make it to year two. And last year, 46% of the 27,000 real estate agents in Metro Denver did not close a single deal. And there was no anomaly about last year because this is a hard number. We've been tracking this forever. It's always between about 45 and 48%. And I have no idea why, but we've probably been tracking this for 12 years. Just always 45 to 48% of Denver real estate agents do not close a single deal.
And what's the 1 year renewal for agents coming from? Because isn't DORA, the governing body in Colorado, don't they have agents renew every 3 years?
Well, no, you have to actually do your CE credit and stuff and renew that way. But this is just people who actually don't pay the licensing fee and after 1 year actually get out. Yeah, that's their data.
Okay.
like 7 out of 8. So we bring on, your castle is 550 agents. We work with a lot of new agents. We do the very best we can with them, but a lot just, I don't know. It's a relatively tough business to get into because you're starting your own business. And what we find is people who have started a business before and done that tend to have a little bit more of the skills, the prospecting skills, the business building skills. No IQ. There's no correlation to IQ or height or weight or anything like that. We've tried to figure this out, but the people who know how to prospect and talk to people and be very, very organized and methodical, those are the ones who tend to be the ones who make it in real estate. But that's, of course, a vast generalization.
And Charles, can you hear me?
Mm-hmm.
Great. My internet's starting to cut in and out, so I want to make sure. All right, guys, we've covered the bullet point topics that Charles and I wrote down for this webinar. Like I said, it's a little bit shorter than usual since we have no deals to discuss, unfortunately. But our goal is to be transparent and be real and say, hey, here's what's going on the market. Here's what we're doing. So if you've got final questions, start typing them in now, and we'll start wrapping up here in a few minutes. And Charles, for perspective, you said this, I remember you mentioned this a couple of weeks ago now, but you said this is only like the second or third time in your career that you've not had properties under contract. It was a very, very significant stat you shared with me about your personal production.
Yeah, it is. Third or fourth time in 13 and a half years that I don't at this moment have anything under contract. And it's actually the longest period of time. It's been maybe 4 or 5 weeks. It's just, I'm a pretty busy guy. I'm a pretty productive agent. And about 70% of what I do is with investors and generally always have 2, 3. My record was I had 16 under contract a summer and a half ago for a couple of weeks. I mean, that was juggling a lot. And I have nothing under contract. And the bottom line is, there's just not a lot of inventory. The numbers aren't doing too good. I spoke with one of our clients yesterday who's got hundreds of thousands of dollars to invest. And I'm like, yeah, just hold off. Be a little bit patient. Just be a little bit patient. I really believe that things will start to come on in the spring. We had a very similar period of time last January and February. And that was the last time I had nothing under contract. And I was even more surprised then. But yeah, I mean, I'm just an agent, and I don't want people buying properties when it doesn't make sense. So I would say I'm fairly optimistic in the next few weeks to a month. I've got to believe more inventory is going to come on the market.
Great. All right, so I see no more questions coming in, so I'll start wrapping things up. Just a reminder, on that March 13th, we are doing the first Investor Advantage, I'll say lunch and learn. That's at 11:30 a.m. Go to the Your Castle website, go to DenverInvestmentRealEstate.com, the event calendar there. All the details are on there. Something else just to keep your eyes open for. We're doing a lot more webinars, a lot more podcasts now, and we're making a big push to do webinars with just other professionals in different segments of the real estate industry around Denver, and even reaching out to some other markets in Colorado. So just keep your eyes open for it. We got a lot of interesting ones lined up that aren't on the calendar next week or aren't on the calendar. But next Wednesday, March 7th, we've got a webinar with a tax attorney for tax and business planning for real estate professionals. So that's more geared towards real estate agents. I know we also have a lot of investors out there that have their license as well to help do their own deals. So probably a good idea for you to hop on that webinar as well to pick up some tidbits on how you can take more advantage of writing things off for your business. So that's next week. Just checking through the comments. Thank you guys for coming out. You're welcome. You're welcome. All right, everyone. Charles, thank you for your time this morning. I know you're busy. And everyone that came out, thank you for sharing your morning with us. Have a great day, everyone.
Thanks, Chris.